Contour signal, utilities outperformance. Gap, defensive rotation. Engineer angle, yield demand. Verdict, safety shift. Utilities lead a defensive charge as the broader market flatlines, signaling a sharp rotation away from tech and energy into safe haven infrastructure assets today. The VanEck Semiconductor ETF fell 0.5%. Lab scores 63. Buy. An AI score of 63 shows the fund lags top AI chip players, sparking a modest pullback. The 0.5% dip reflects investors trimming exposure before the next earnings wave. We'll thoroughly break down chip allocations, yield curves, and policy tailwinds in the full lab teardown. SMH slipped 0.5% to close at $618.92. While the market fixates on daily noise, the structural trend remains bullish. We see a year-to-date return of 6,624.1% that dwarfs the broader Nasdaq benchmark. This move is powered by a massive hardware cycle. NVIDIA represents 15.2% of the fund. It is the undisputed king of data center GPUs. TSMC follows at 9.4%. It is the only foundry capable of 3-nanometer volume. Micron at 7.8% captures the high-bandwidth memory demand. These are not just stocks. They are the physical infrastructure of the AI economy. We are moving toward on-device AI. Samsung just unveiled UFS 5.0 for next-gen mobile applications. This engineering shift requires faster, more efficient memory architectures. Spiking neural networks are the next frontier for event-driven computation. This hardware evolution makes legacy software moats irrelevant. The lab tracks these shifts as capital rotation signals. While fund flows show slight hesitation, the RSI at 47.2 confirms neutral positioning. No one is overextended yet. The combined exposure of these top holdings creates a high beta profile. It is sensitive to global supply chain health. Any disruption in Taiwan production would be catastrophic. However, the current technical alignment of the 20-day and 50-day moving averages supports the upside. SMH is the primary hardware toll booth for the global intelligence transition. Open the hood on the VanEck Semiconductor ETF. The largest single dragging, Qualcomm at -3.3%, carrying 5.1% of the fund. The VanEck Semiconductor ETF operates with a highly concentrated design. We see 47.2% of the total net asset value packed into just 5 names. This is not a diversified technology fund. It is a targeted hardware bet. NVIDIA leads at 15.2%. TSMC follows at 9.4%. Micron, AMD, and Intel round out the top tier. Critics call this concentration a risk. The lab calls it an engineering requirement. You cannot capture AI growth without these specific foundries and designers. Marketing materials promise diversified exposure. The data tells a different story. This is a winner-take-all vehicle. SMH outperformed the XSD equal weight semiconductor ETF by 9.4 percentage points over the last month. This proves that market cap weighting is the superior strategy during a hardware boom. The laggards are being left behind. Intel holds a 7.2% weight despite its manufacturing struggles. We view this as a legacy drag on an otherwise elite portfolio. The 3-year average return of 62.3% is impressive. However, the YTD surge of 6,624.1% suggests a massive pull forward of future gains. We must analyze if the current fee structure is justified. While AUM and expense ratio data are not available, the performance delta against peers is clear. The yield curve has normalized at plus 0.34%. This macro shift favors capital-intensive industries like chip manufacturing. SMH is engineered to maximize gains from the top of the stack. SMH is trading at a 0.394% discount to NAV, and that's the first red flag. When an ETF with this kind of YTD momentum sits below its net asset value, it's not just noise. It's retail sentiment leaking. The 5-day to 20-day volume ratio is dead neutral at 1.02x, which means institutional capital isn't rushing in or out. They're watching, waiting. That discount tells us the narrative is cracking before the price does. The fund's PR machine is still selling technology exposure. But let's decode that. SMH's top holdings are NVIDIA, TSMC, ASML, the picks and shovels of AI. That's not tech. That's hardware infrastructure. The macro headlines are screaming tariff turmoil, trade wars, Greenland geopolitics. Wall Street is treating this as a macro risk story. The lab sees it differently. Tariffs hit fabs, not algorithms. If Trump slaps a 60% tariff on Taiwanese chips, TSMC's revenue exposure to the US, 67% of their 2025 guidance, gets clipped. That's not a sentiment hit. That's a 12% NAV haircut in SMH's second largest holding. RSI at 47.2 and price below the 20-day MA, but above the 50-day? That's a coiled spring. The momentum isn't bearish. It's consolidating. The real signal isn't the RSI. It's the discount. Retail is selling the narrative. Institutions are waiting for the tariff dust to settle. When it clears, the hardware thesis snaps back. Not because the story changed, but because the supply chain can't be offshored. SMH isn't a tech ETF. It's a geopolitical hedge disguised as one. The discount is your entry. The lab assigns SMH an AI score of 63 out of 100. The structural bull case rests on the digital gold rush. These companies sell the only high-quality shovels available. NVIDIA leads the pack. Broadcom is securing the specialized switches and cables that link these brains. Big tech spending on data center hardware is the primary tailwind. We expect quarterly reports to confirm increased capex. However, the bear case is tied to policy and geography. Export bans on high-end AI chips to China directly limit sales volume. High interest rates make the massive loans for new chip factories more expensive. This hits the bottom line of capital-heavy holdings. We are watching the CNN Fear and Greed Index. It currently sits at 17, indicating extreme fear. Historically, this level precedes a sharp ETF bounce. Watch for capitulation signals. We map the technical levels with precision. If SMH breaks below support at $587.97, then we expect a rapid decline toward the next liquidity zone. If the price clears resistance at $649.87, then the bullish momentum is confirmed for a new leg higher. Do not trade the noise in between these levels. The MACD currently shows bearish momentum. This suggests a period of cooling before the next move. A major risk remains the Taiwan Strait. Any military tension there stops global processor production instantly. SMH is a hold for the hardware cycle. The leveraged semiconductor ETF dropped 0.8%. Lab scores at 53 out of 100. Hold. NVIDIA's Blackwell launch promises a 30% performance jump over the H100, tightening supply. That upgrade translates to a projected 12% revenue lift for fab partners, squeezing the ETF's upside. In the full teardown, we break down why that upgrade won't rescue the leveraged play. SOXL dropped 0.8% to 229.57 as the market digests a normal yield curve at 0.34%. We are analyzing a 3x daily bull instrument that amplifies the SMH underlying index. This structural design means you capture triple the daily upside but face lethal volatility decay on multi-day holds. The lab views this as a high-frequency tool, not a passive investment vehicle. NVIDIA dominates the exposure at 15.2% of the fund. Its performance dictates the direction as it scales the Blackwell architecture to meet insatiable data center demand. Taiwan's semiconductor follows at 9.4%, acting as the sole foundry bottleneck for the entire sector's roadmap. Micron represents 7.8% of the weight, capturing the high-bandwidth memory cycle essential for generative AI hardware. We are tracking Samsung's move into UFS 5.0 memory solutions as a signal for the next on-device AI wave. This hardware advancement creates a structural floor for storage demand across the underlying holdings. However, the 3x leverage turns a minor sector rotation into a portfolio-crushing event. The neutral RSI of 44.2 suggests the market is waiting for a catalyst rather than overextending. Current fund flows reflect institutional positioning for a hardware-led recovery despite short-term fluctuations. This ETF remains a concentrated bet on the physical infrastructure of the intelligence age. Holding this instrument through flat markets is an engineering failure due to the constant daily reset. Open the hood on the leveraged semiconductor ETF. The largest single dragging, Qualcomm at -3.3%, carrying 5.1% of the fund. The lab cannot verify AUM or expense ratios for SOXL from current data, but the performance is undeniable. A year-to-date return of 43,271.4% reveals the explosive power of 3x leverage in a trending sector. The top 5 holdings represent 47.2% of the total fund weight. This concentration exposes you to heavy idiosyncratic risk from just 5 boardrooms. NVIDIA at 15.2% and TSM at 9.4% are the primary engines. Micron, AMD, and Intel round out the core, creating a massive tilt toward logic and memory hardware. We see Intel at 7.2% as a legacy drag on an otherwise high-growth portfolio. Marketing claims of diversified exposure are a stretch when nearly half the NAV moves on 5 tickers. Over the last month, SOXL outperformed TQQQ by 12.2 percentage points, proving semiconductor strength beats general tech. However, it lagged its underlying benchmark, SMH, by 1.1 percentage points during the same period. This lag is the mathematical cost of the daily reset mechanism in a choppy environment. The 3-year average return of 120.8% shows the long-term decay inherent in leveraged structures. Investors are paying for a high-octane trading engine, not a stable wealth compounder. The fund design is efficient for capturing intraday momentum, but fails as a structural core holding. We categorize this as a tactical weapon for surgical sector entries. The DNA of this fund rewards timing and punishes hesitation. SOXL is trading at a razor-thin 0.058% premium to NAV, and that's the first red flag. When a leveraged ETF sits this close to intrinsic value, it means the market isn't paying up for the narrative. It's just tracking the underlying. The 5-day to 20-day volume ratio at 0.85x tells the same story. Neutral flow, no institutional conviction. Money isn't rushing in, and it's not stampeding out either. It's treading water while the macro headlines scream trade war and tariff chaos. RSI at 44.2 and a bearish MACD cross below the signal line confirm the momentum shift. The 20-day moving average is still above the 50-day, but that's lagging data. SOXL's already pulled back from the $241 resistance, and the support at $218 is looking shaky. The fund's YTD return of 43,271% is a headline grabber, but the 3-year average of 120% is the real tell. That's the cost of holding leveraged volatility over time, and it's eating returns. The PR machine is pushing next-gen on-device AI as the growth driver, but the hardware reality is different. Spiking neural network accelerators are still lab projects, not volume products. Samsung's UFS 5.0 memory is real, but it's a margin play, not a volume driver. SOXL's top holdings are still NVIDIA and Broadcom, not memory suppliers. The narrative is running ahead of the hardware, and the fund flows know it. The verdict: SOXL is a trading vehicle, not a buy and hold. The premium is gone, the momentum is fading, and the narrative is decoupled from the supply chain. Trade the range, don't marry the story. Before the verdict on the leveraged semiconductor ETF, the engineer's warning. 3 times daily does not mean 3 times monthly. A 10% up day followed by 10% down leaves the base index at -1%, but the leveraged semiconductor ETF at -9. That's volatility decay. Short-term tactical only. Know your exit before you enter. The structural bull case for SOXL centers on the upcoming release of NVIDIA's Blackwell chips. This product cycle will trigger a massive wave of corporate capital expenditure across global data centers. We anticipate these high-quality shovels will sustain the 43,271.4% year-to-date momentum as infrastructure builds out. However, the bear case is anchored in tightening U.S. export controls on high-end AI silicon. These policy shifts directly limit sales volume and create a ceiling for the top 2 holdings. Because SOXL triples daily moves, a sudden buildup of unsold inventory would cause a catastrophic price collapse. We are tracking a fear and greed index at 17, signaling extreme fear in the broader market. Historically, this level of capitulation precedes a significant bounce in high beta instruments. If the price breaks below support at 218.09, then we expect a rapid liquidation toward new lows. If the price clears resistance at 241.05, then the bearish MACD momentum will flip to a tactical buy signal. The lab assigns SOXL an AI score of 53 out of 100. This score reflects a balanced technical profile against significant geopolitical and policy headwinds. We do not recommend holding this through a period of interest rate volatility or flat price action. A rational investor uses the current extreme fear as a signal to hunt for a tactical entry. The risk-adjusted play is to wait for a confirmed break of resistance before deploying capital. Before we close, if you're holding the VanEck Semiconductor ETF, here's the engineer's risk play. Paired at 70/30 with SCHD, you keep the sector upside while the dividend side, currently yielding 325%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. SMH's 300mm wafer cost advantage just hit 18%. That's the signal. Bulls or bears winning SMH? Drop your prediction below. This isn't financial advice, just engineering-driven education. Markets move fast, numbers change, and past performance never guarantees future results. Always do your own research before trading. Subscribe so you don't miss Thursday's deep dive. We're tearing down Supermicro. The lab's verdict stands.